Hi friends, my name is Pramod Deshmukh and I am from Vision Achieved Stock Market Training Program. In this video presentation, I will share the performance of TCS, my personal analysis of Tata Consultancy Services annual and quarterly performance for the results which they declared 2 days back on 12th of April 2023. Okay. So first the disclaimer, this video is made using information available in public domain and I have developed it for my personal practice as well as to ensure that those who are like me could understand what are the benefits of owning a TCS share and how is the company performing in last 12 months and as well as in last several years. Okay. So the entire data has been collected from public domain from various websites. However, in particularly, I'm using a website called screener.in. And in the text of this video, you can download the data, one Excel sheet, which I have prepared to calculate all the ratio analysis. Okay. So let's start. Let's begin the TCS annual performance. We'll start with year-on-year performance growth. So what is this table I'm going to present? It is the annual performance of results of last 10 years. Okay. And this is it. So in past 10 years, how their sale has been, what is the operating profit, what is the net profit, earning per share, how much dividend they have been paying, all that is in this table. And what are we measuring? We are measuring growth in comparison with the previous years. And we are especially interested in the last 2 years, March 2022, the growth achieved after March 2022 in the year March 2023. And how to assess the growth? My request to all of you is during this presentation, focus on green color. Green means improvement. Green means good. Yellow means neutral or median. And red means definitely a concern. Okay. So this is a very simple presentation. You will be able to assess the growth or the performance of any company using simply by focusing on the green, yellow, and red color. Okay. So let's begin. In particular, we are interested in performance improvement in last 2 years. Okay. Now, previous year to this year. So first parameter is obviously the revenue, sales, total earning. TCS has done phenomenally well. Their total sales has now grown to 2,25,000 crore in 1 year, which last year was 191 crore, which is a plus sign. Their operating profit, which is also known as EBITDA, EBITDA stands for earning before interest, tax, depreciation, and amortization, which is a very popular term. That has also improved from 53,000 crore to 59,000 crore. Interest. Gone are the days where TCS was a debt-free company, where initially from 2014 up to 2019 or even 18, they are paying hardly any interest. But after that, the company has started paying huge amount in interest. Interest grew to 924 crore, and last year they paid 779 crore. Now this is a big amount to pay interest. That means the debt is also very high, and we'll talk about it later. Profit before tax also has grown. So interest has been on the rise. That's what that elliptical circle is showing. Profit before tax has improved from 51,000 crore to 56,000 crore here. And net profit as tax, they are regularly paying decent tax as per the norms of the government, and their profit after tax has improved from 38,000 crore to 42,000 crore, as well as earning per share, phenomenal. The point number 10 is dividend. This year they have declared dividend of 99.86, meaning entire 42,000 crore has gone in dividend, like 99.86% of 42,000 crore has gone in dividend, which is not a healthy sign for any business, because the dharma of a business is not only give profit to the owners, but also reinvest the profit amount back into the growth of business. And particularly this year, that amount is required because next 12 months, the growth is not going to be as good as it was projected in early previous years. Okay, and because the world economy is down. So as a result, I have given here -1 marks to TCS and -1 mark for high interest. So out of 10, here we'll give them 8 marks, 8 out of 10. So now let's move on to parameter no, number 2, which is quarter after quarter performance. So what is this table? This is past 10 quarter performance and growth rate per quarter. So the results, the numbers here are from December 2022 quarter. Quarter is 3 months, right? So December 2020 till this quarter, which is March 2023, 10 quarters. And what are we measuring here? We are again measuring growth in comparison with the previous quarter. Quarter after quarter, are they growing? That's what this parameter is. And what do we have to look? Look for the green color. Subsequent slide, I will not be talking about this. So green means good, yellow means neutral or median point, and red is definitely a concern. So look at the total sales. In last 10 quarters, the sale per quarter every 3 months has been growing. Similarly, the rate at which the sale is growing is pretty much in the range of 3 to 4%. But in this last quarter, the growth rate dropped to 1.6%, which is definitely a positive growth, but it was not average of all the previous quarters, which is between 4 and 5. Now it has dropped to 1.6. Operating profit has also been in the range of 12,000 crore to going up to 15,000 crore. But for few quarters, the growth dropped, so which is a concern area. However, we are measuring only last 2 quarters. Here, the growth rate of operating profit has also fallen. And net profit is growing at a constant rate. The net amount is increasing, whereas percentage has not been the same. And last quarter, the growth has been 5%. So here, because of the continuous growth, we will give them 3 out of 3 on all 3 parameters. Okay? Now let's move on to ratio analysis. I conduct Vision Achieved Learn to Earn from Equity Stock training program where we go deep into company performance and then choose to invest in companies so that over a period of say 45 days to 90 days or 90 days to 1 year and 1 year to multiple years, we could identify companies which will grow fast. So therefore, you will learn more about ratio analysis in this training program. So we will now go through the outcome of these ratio analysis. So first one is the performance overview and per share analysis. So what is this table? This is again growth compared to previous years of performance, right? So what are we measuring? Percentage of growth. And what are the parameters? Annual revenue growth. So first line you saw there was total sales, revenue was growing. So is the revenue growing? Our area of interest is last 2 years. Last year it was growing at 16.8%. This year it has grown to 17.6%, which is very good. However, the net profit has dropped. The growth percentage, the growth rate of net profit has fallen from 18.2 to 10%. Earning per share has gone up from 104 to 115, and book value per share, we just got the number, which is 245, which is pretty much flat. Last year it was 243 rupees per share. To this year it has marginally increased to 245. And return on equity is also flat. 43% last year, it was 46% this year. And the interesting thing is the debt to equity ratio. TCS is no more a debt-free company. It has started taking debt, and that debt brings pressure on the performance. So we'll give -1 mark here and +1 to all other because the numbers are positive and have shown growth. So on this parameter, we are giving them 5 out of 6. Okay? The next is ratio analysis, the important ratio analysis. ROE, ROCE, and ROA. What does it mean? ROE stands for return on equity or return on net worth. ROCE is return on capital employed and return on assets. So if you see here, the entire chart is green and has been consistently growing. Especially the last 2 years, the numbers have grown. So here, straightway, we will give them 3 out of 3. So what is exactly these and what is the role of these? I can explain you in my subsequent video, or you could join my program to learn more about it. These are very significant. Wherever these ratios are on the rise, you will see the FIIs and FPIs are investing money in those companies. Okay, and TCS is one of them. Next, liquidity ratio. Two important parameters, current ratio and quick ratio. So if you see here, up to 2019, the numbers were phenomenally very high, current ratio. Why? Because the debt amount was practically zero, very low, few crore, 20 crore, 10 crore, 3 crore, 5 crore. But then TCS has taken a big debt amount, almost like $1 billion in 2020. After that, because of the debt, this ratio dropped significantly. But from then on, so it has been increasing. 4.92 has become 5 to 6.69 to 6.78. And therefore, we are giving them 1 mark each. So because of this debt, the number which used to be phenomenally high, what does it mean? Current ratio means the company for every expense of 1 rupee was able to generate 648 rupees 45 paisa. But now for every expense of 1 rupee, company has 4.92 rupees at any given time. That is current ratio, and similar is the quick ratio. Okay? The next ratio is leverage ratio. Here there are two kind of ratios, which is interest coverage ratio and debt to equity ratio. And interest coverage ratio is how much money they have surplus for the interest they are paying. So up to 2019, the numbers were phenomenally high. Like for example, in 2019, for every 1 rupee of interest to be paid, they had 210 rupees surplus, which now has changed after this $1 billion borrowing. Now for every 1 rupee of interest to be paid, they have 74 rupees, which is significantly high. But then still it has an impact of the $1 billion borrowing. And the debt to equity ratio, which used to be very close to zero, has now increased to 9.7 in 2020, which is dropping to 8.5, but still significantly high. And therefore, we will give them -1 here, and we'll give them only 1 mark out of 2 on debt to equity ratio. The next one is the margin ratio. Margin ratio beside the gross margin, profit after tax, profit before tax, and net margin. These numbers, TCS is breaking all records. They are doing phenomenally well. And this is the reason this is the India's one of the best star performing company. All three are green, and therefore we'll give them 3 out of 3. Okay. Next is the compounded annual growth. Can you imagine a large corporation not only growing, for 10 years they have been growing their sale at a rate of 11.9, close to 12%. Past 7 years, if you see, it is 11%. 5 years, if you see, compounded growth has been 12.9, and past 3 years, compounded growth has been 12.8. Phenomenal, very good. Operating profit is also in the range of about 27.3%. And price to earning ratio has subsequently increased from 25.44 to last 3 years is 31.98. Very good. So we'll give them 1 mark each here. And do they believe in paying tax? Yes, they have been consistently paying a very high amount of tax, which is in line with the corporate tax rate of about 24 to 25% per annum. Okay, so here we will give them 4 out of 4. 4 out of 4. Okay. So let's move on to the next rate. Ratio analysis, cash flow. This is one of the most important ratio analysis. How are they managing cash? The business cash management is one of the key to the success of business because it has 3 parameters. First one is cash from operating activity. Now, this is completely in the hand of the CEO, CFO, every employee work to improve the operating cash. And if you look at TCS, from 2014 onwards, their operating cash flow has been growing till last year, but this year there is a drop, significant drop, almost like 25%, 75% drop. It is just 25% off. So 11,500 crore down. At the same time, their cash from investing activity, where this is in the hand of CEO, CFO, this is in the hand of board of director. These two are very important. Now, the board of director comes in and they can move the cash out of the company in the name of investment, right? So TCS has been pulling money out at various occasions. Now the duty of a company is to bring the money back at various occasions. So this year, investing activity money has come huge amount, like 15,000 crore is back. So which is good sign. And the third one is the cash from financing activity, which is where the dividend comes in, financing cash flow items, issuance of new stock, and issuance of debt. All that is taken care in finance activity. This has been red for several years for TCS, which is not a good sign. And the last one is the net cash flow. If your summation of these three should be a positive number. So TCS has not been able to maintain this number positive for all year, and even this year, TCS has not done well. Okay, this number is negative. Okay, so we will give them -1 mark here and a -1 mark here for the occasion of for not doing good job with the cash flow. Okay, and which is the dream company? The day you find a company which has got all greens for throughout the history is the dream company, where the net cash flow year after year becomes green. That is a best company to invest in. Unfortunately, even TCS is not that company. Okay. So here we will give them 2 marks out of 4. Cash flow management is not doing well. In fact, it's a reality that now TCS is the flagship company of Tata Group, and past few years they have been pulling out a lot of money from this company into other businesses, and this, which is this is a cash cow which is funding probably their other businesses. Okay? And now I'm going to discuss the most important ratio, which is known as self-sustainable growth rate. Can TCS stand on its feet and sustain growth by itself? For that, there are calculation and formulas. Okay? So SSGR, self-sustainable growth rate. If you look at the history, 2014, it used to be very high, 2015, 2016, up to 2019, SSGR was significantly high. And then it dropped, and then it increased and increased, and this year it suddenly became a negative number. Now, why it is so? It means that the company is not putting money back into the business, whatever the net profit they are earning. Okay, so this year, company has earned huge net profit. At the same time, they have declared 100% dividend. So that means full net profit has gone to the stockholders, shareholders. Nothing left to reinvest, and therefore their SSGR has dropped to -24. And this number can also be read as, to generate a sale of 2,25,000 crore, TCS had to take a loan of 7,688 crore. Or you can also say, to generate a profit of 56,000 crore net profit, TCS had to take a loan of 7,688 crore, 3.4% of the total sales. Therefore, we are giving them a -1 here. Okay. So the next ratio analysis is the stock valuation ratio. What all is covered? Stock performance and future potential. Okay. So here there are 3 ratios. One is the P ratio, price to earning ratio. Price is the stock price divided by earning per share. That ratio is very significant. And this is still, in early 20s. There are companies which have shown price to earning ratio as 1,000, like Adani Green and all those companies. And you know what happened to those stocks. TCS is still in an affordable range for a 1 rupee stock, right? PEG ratio is price to earning ratio divided by the growth in earning per share. So earning per share is the growth rate, which is current year minus previous year divided by previous year is the growth, right? So that when you divide these two, you get a number. Now this shows how much is the overvaluation of the stock has been done. Okay? So this ratio also tells us how much market values this stock. So currently that value is a perceived notional number. It's 279. Higher the better. Okay? And then EY ratio is the earning yield ratio. Like in compared to a government uh, interest rates like a FD or a bond, how much TCS is going to do or going to deliver. So TCS is offering you in the range of 3 to 4%. Okay? So here I have given TCS minus 2. Okay? Only 1 out of 3 because these two numbers are P ratio has dropped and their EY ratio has dropped. So coming to last ratio analysis, which is known as Piotrowski score. Professor Piotrowski in US have created a simple table to measure the operational efficiency, financial profitability, and the leverage liquidity and source of fund ratios. So he compared various ratios with each other and he created a score, and for everything you can give a score as given in this table. So last year TCS Piotrowski score was 7. This year it has dropped to 5. So there are 9 parameters. So we'll give them 9 marks total. So we have given them 5 out of 9. So this is how TCS is performing. So TCS also has a dividend history. Phenomenal. This company pays its stock owners. So in last 10 years, if you see the record from 2014 onwards till now, 43 occasions of dividend paid have happened, and more than 450 rupees has been paid in the form of dividend. And there have been a one occasion of 1:1 bonus share, where your number of shares just doubled, right? So this is something phenomenal about TCS. So if you just buy a TCS share and keep it for 8, 10, 20 years, you will automatically become rich because of this one company, provided the company continue to perform the way it has been doing in the past. Okay? And the next thing is, so let's do overall performance. Overall performance, TCS has scored 37 out of 50. This is the score means it has passed. It is one of the best company performing in India and giving consistently great results. So what are the major concerns? TCS management now is pulling out profits to fund other businesses instead of reinvesting. So that's a concern. Investing cash flow is under pressure and finance cash flow is also has been negative. They are giving huge dividend. Probably they own 72% in the company. So they are pulling out every profit they want it back to invest in some other companies like Air India or could be other, we don't know. Self-sustainable growth rate this year has been 0. It means the company is not reinvesting money back into the business, which is a concern. And next year is because of slowdown, the margins are under pressure, the business is under pressure. Company has not given any preference to become a debt-free company. Their $1 billion of debt, whatever they have, 8,000 crore debt, they could have paid it and come out of it. But in spite of poor growth projection in 2024, they continued with the debt and they choose to give 100% dividend of the net profit. The net profit is not a small amount. It is 56,000 crore and the debt is 8,000 crore. So it's like, almost like 7 times profit they already done of the debt amount, but still they did not pay. So what is my recommendation to you? You buy this stock and keep it for 3 to 5 years. And just, you will, the year-on-year dividend which TCS has been paying, because this is a cash cow company, this company will perform well and all the profit will be Bombay House, the TCS headquarter, they will try to pull it out. So you will continue to get dividend from this company and your stock will start getting discounted, right? So that is the beauty. So with that, we come to the end of TCS stock performance. I hope you saw some value. So now in the comment section, you please put your comment, what you learned, what was good, what you want to see more. I will very soon come with the next stock performance for you. Okay. Thank you very much. Have a nice day. Bye.